Good day, ladies and gentlemen, and welcome to Quarter 4 2018 Webcast. All lines have been placed on a listen-only mode, and the floor will be open for questions and comments following the presentation. If you should require assistance throughout the conference, please press *0 on your telephone keypad to reach a live operator. At this time, it is my pleasure to turn the floor over to your host, Jordan Kahn. Sir, the floor is yours.
Thank you, operator, and thank you, everybody who dialed in today for our Q4 2018 webcast. Today, we're going to take a look at answering this question that has been making the rounds in the financial media and has been on the minds of a lot of investors, and that is, has the cycle peaked? And when we refer to the cycle, what we're really talking about is the business cycle, which is a combination of both the economic cycle as well as the corporate profit cycle. So today we'll discuss some of the bull and bear arguments on both sides of the equation and also where we come out on the current debate. First thing we want to take a look at, and this is an update of a chart that we've shown before, this is a chart of the current economic growth as measured by GDP or gross domestic product. And one of the things you'll see here is this nice upward trend that we've seen really for the last 2+ years. We've had 9 consecutive quarters of accelerating economic growth. And so the question now is, with this most recent quarter that came in a little bit above 3%, the question is, have we seen the peak in economic growth? The answer to that is probably yes. In terms of growth rates, we may have seen the strongest quarter recently that we're going to see this cycle, but that doesn't necessarily mean that things are going to immediately roll over to the downside, right? A peak in terms of economic growth doesn't necessarily mean an end to economic growth. The economy can still continue to grow for a while after this, albeit at slower rates, right? So maybe we'll see economic growth trend back down towards 2%, but slower growth doesn't equate to a recession. To get into an economic recession, what we really have to see is 2 quarters of negative growth, or actually a contraction in the economy. And so we don't think that we're near that yet. Another chart, another economic indicator that we look at is consumer confidence. One of the things that you'll see here, if you look at this purple line, is that this purple chart right there, is that consumer confidence is at multi-decade highs. So this bodes well for consumer spending. If consumers feel confident about things, they are more apt to spend more. This is likely to translate into strong holiday sales this coming holiday season for retailers. And given that consumer spending makes up more than 2/3 of the U.S. economy, this probably also bodes well for continued economic growth in the near to intermediate term. What about businesses? So we talked about the consumers. This is a popular economic indicator in terms of tracking businesses and more specifically the manufacturing sector, and this is industrial production. So again, if you look at the far right side of this chart, you see an acceleration recently in industrial production. This is, if you squint, you could tell this is about the second highest reading in roughly 20 years on this chart. And strong industrial production usually leads to stronger capital expenditures or investments on the part of businesses. What's interesting is that despite industrial production accelerating for the last couple of years, we haven't really seen a big increase in CapEx yet, or business investment capital expenditures. And so if we don't see that show up here, if we don't see increasing numbers in terms of capital expenditures over the next few quarters, we would view that maybe not as a red flag, but probably a yellow flag. So that's something that we're going to be looking out for. The next chart is of average hourly earnings. This is a component of the jobs report that comes out every month, and it shows the increases in workers' wages expressed in percentage terms. So again, on the right side, you'll see this indicator has spiked higher recently. The most recent average hourly earnings that came in the jobs report was actually showed 3.1% year-over-year growth. That's the strongest showing since 2009. And since wages are a big component of labor costs, this is the strength that we're seeing now. It probably means that the Fed is likely to stay on their recent path towards hiking interest rates. So we've already seen them hike rates several times in the last couple of years. The markets are currently pricing in another rate hike for December, and then the current projections right now are for 2 more rate hikes in 2019. Since the Fed has said that they're data dependent, meaning that they're watching all of these economic indicators that we are, some of the whether those 2 rate hikes will actually come to fruition in 2019, some of that depends on how strong the economic data continues to come in, but those are the current projections. And in terms of this spike higher in average hourly earnings, one of the things that we often have seen in past cycles is that when wage costs start going up, the market starts getting concerned about inflationary pressures, right? Does this increase in wages translate into higher inflation in the economy? And so far, when we look at different inflation indicators, so far we would have to say that the answer is no, that the recent increases in average hourly earnings or wage cost hasn't necessarily translated into higher inflation expectations for the overall economy. This chart is of one inflation gauge that's called the PCE core inflation. This is actually the Federal Reserve's preferred measure of inflation. And so what you can see on this chart is that during the last cycle, when inflation was running above 2.2%, it wasn't until 2008 that we saw inflation first move below 2%. Since then, it's been very difficult to even get back to that 2% level. Right now, we're just getting back to about 2% inflation. And the Fed has said when inflation was running very low and people were more worried about deflation than inflation, the Fed kind of set this target, saying that they would like to see inflation get back to the 2% target level. So judging by this indicator, inflation is really just getting back to this 2% level, but we're not really seeing a big breakout higher than that. So our read is really that the market, that investors aren't overly worried about inflation pressures picking up in the intermediate term. We've also seen oil prices come down quite a bit recently, and that kind of plays into the overall inflation picture. So right now, this isn't a big issue. In past cycles, one of the things that has happened is that inflation has started to pick up and grow at above average rates, and that has caused the Fed to increase their rate hikes with the intention of slowing down the economy and slowing the inflation pressures. So speaking of the Fed and speaking of rate hikes, this is a very long-term chart. This actually goes back 30 plus years, but this is a long-term chart of interest rates as measured by the 10-year Treasury bond. And again, it's difficult to see on this chart, but if you'll squint, you see that this low that we made in 2016, since then, we have seen a fairly quick rise in terms of interest rates going up, of this 10-year yield on the Treasury bond increasing. But if you put that in context of this longer-term chart, you'll really see that the recent rise in these 10-year yields has only gotten us back to this long-term downtrend that's been in place for the last 30 years. So it doesn't, again, looking at the longer-term perspective, it doesn't look like we've seen a big breakout in terms of bond yields. It's really just getting back to trend. The pace of the rate hikes and the pace of the increases that we've seen in the 10-year hasn't been overly worrisome to stock investors. If interest rates, really began to spike higher, it would probably become more worrisome to stock investors. But today, the 10-year closed at about under 3.25, at about 3.23. We think maybe it could drift a little bit higher, maybe to 3.5%, but there's probably a lot of resistance at that 3.5 level. And that could be the top or the ceiling for this cycle. So that's another thing that we'll have to monitor. But overall, in the context of this chart, rates are still somewhat low on a historical basis. What about earnings growth? Earnings growth is obviously another big part of the picture. Recently, when measured on a year-over-year basis, we've seen some big increases in earnings growth. On this chart, the most recent quarter that we're in, even though it's not fully completed yet, but right now the current estimates for third quarter earnings are to see year-over-year growth of 32%. So it's a really, really strong number. That's actually the fastest earnings growth that we will have seen in the last 8 years. So again, the question is, on investors' minds, is have we seen a peak in earnings growth? And again, if earnings are growing 32%, the answer is probably yes. That probably is the highest growth rate that we'll see this cycle, but it doesn't necessarily mean that earnings are about to collapse, right? Even though growth rates may have peaked, earnings can still grow, albeit at lower levels. So when we look at the current earnings estimates for 2019, we see that 2019 earnings growth is still expected to come in at double digits, which is a very nice showing, just not quite as high as we've seen now. So earnings can still grow at a slower pace, and the fact that earnings are still positive in a directional sense probably should help support stock prices going forward. In terms of the midterms that we've seen, this is a chart that we showed in our last quarterly market monitor. What this chart shows is how stocks have fared after the midterm elections. So coming into the elections, one of the things that we talked about, we wrote about this earlier in the year, and we mentioned several times that 2017 was a year that saw very, very low market volatility. And we said coming into 2018 that we were expecting to see a pickup in market volatility, more back to historical norms. This study, when they looked at midterm election years going all the way back to 1946, one of the things that they found was that the average correction in the market in the months leading up to the midterms was about 14%. So the recent correction that we just experienced was about a 10% pullback. And that type of volatility is probably within the historical norms that this study showed going back 50 plus years. The silver lining from the study was that once you get past the midterm elections, it's often a very, very positive time period for the markets. And so when they went back to 1946, there hasn't been one data point or time period on here that actually showed a decline in stocks. And the average gain for all of these years averaged about 15%. So we've already seen a little bit of a rally the day after the midterms. Right now, we only need about 5% more appreciation in the market to get back to the recent highs. What about investor sentiment? If you look at this chart, this is something that we also follow to see where investors are in terms of their levels of complacency or fear. What you'll see on here is that in January, when the market was rallying, investor sentiment got fairly, they describe this as euphoric, right? A little overly complacent. And that happened again in this August-September timeframe. So each time that investor sentiment became overly complacent in these periods, you saw the market pull back or have a big correction. Right now, if you look at this chart, you see that investor sentiment has pulled back to more neutral levels. So with sentiment being back to neutral, we think that that's a good setup for more of a year-end rally in store. Okay, so let's look at some prior cycles when we talk about, has the cycle peaked? The last couple times that we did see the cycle peak, we're going to take a look at how the stock market acted or what you could have gleaned from the action in stock prices. So this is the year 2000. Looking back at 2000, we see that the market had made a high in March, had a big correction from there, rallied back in the summer months and got almost back to new highs here in the fall in the August-September timeframe, and that was really the peak for that cycle. So, lightening up once you saw that the market was unable to make new highs in this August-September timeframe, lightening up was probably a good idea at that time. The next cycle peak was in 2007. What we saw here was you had a market The market rallied to a high in the early spring, had a correction from there, then rallied all the way back to new highs again in the July-August timeframe, experienced another correction, briefly got back to new highs in October, and then from there struggled to make new highs once again. So, again, as we watch for how the market bounces back, whenever the market makes new highs and then it's unable to get back there, that's usually a better sign that the market is showing some weakness. If we look at the current year, we kind of see a similar pattern. Market made a high here in January, had a correction, rallied back in the summer months to make brief marginal highs here in September, October, and is now going through another correction. So the difficulty here is that people want to look at the size or the duration of this correction and make a broader call about the big picture of the cycle. But as you can see from looking back at those past examples, you can't really judge the character of this bull market by the correction. You really have to wait and watch and see the strength of the rebound. So we think that the odds favor the market rallying back to new highs. As the market gets back to new highs, then we'll have to judge the strength of the market at that time. Does it blow past the new highs and continue to work its way higher, or does it struggle at these new highs? Possibly, does it not get back to new highs and start making lower highs? So those are kind of the things that we'll be watching for as the market continues to bounce back. So to recap the things that we went through so far, the economic and fundamental backdrop for the market remains solid. Things look good on that front. There is a strong historical precedent for stocks to do well post the midterm elections. We've already started to see a little bit of that, and we think that is likely to continue into year end. The most likely scenario is that stocks should reach new highs by 2019. There's a chance that stocks could make new highs. We mentioned we're only 5% from the highs, so we could see new highs before year end. If not, we think we're likely to see them at least by early 2019. That said, we are getting into the late innings of this business cycle. We talked about the Fed hiking rates. The Fed has already raised rates several times. At some point, with future rate hikes, we will get to a point where the pace of the hikes and the level that they raise interest rates to will start to choke off credit to the economy, and that's what usually ignites the initial downturn. We already have started to see a couple signs. We've seen the housing market slowing as interest rates have been rising, and we've also seen the global economy slowing down, whether it's China or other emerging markets. We've started to see a bit of slowdown there as well. So taking all these things into consideration, our view right now is that the odds favor becoming a bit more defensive at some point in 2019. So as the market continues to bounce back, as the Fed continues to raise rates, we would look to kind of use that strength to begin to reposition portfolios. And in terms of when we say becoming more defensive, in terms of how that translates into client portfolios, what that really means is that we would look to decrease the current exposure or the current allocation that we have to stocks, to equities, and increase the percentage of exposure that we have to bonds and fixed income and other more defensive type of investments. Okay? So that is where we come out on the question of has the cycle peaked? And with that, I will turn it back to the operator for any questions.
Thank you. The floor is now open for questions. If you do have a question, you may press star 1 on your telephone keypad at this time. You may also type in the Q&A box and hit send. Again, ladies and gentlemen, it's star 1 to be put into the queue on the phone, and to remove yourself if your question has been answered, it's 1. So star 1. Thank you. And we do have a question from Jordan Anthony. Go ahead, Jordan.
When do you think the next recession is coming?
So So that's a good question. There are some models that look at a host of indicators that have been good predictors of recession in the past. These models, they call them recession probability models, and they really forecast the likelihood or the probability of a recession within the next 12 months. Right now, all of these models are at very, very low levels. So the chances of a recession in the next 12 months are really fairly low right now. It would probably take some sort of exogenous shock to the economy to put us into recession at this point. Maybe something like a full-blown trade war, something along those lines. But outside of something like that, our best guess right now is that probably sometime in 2020 would be a higher probability of watching for recession.
Again, ladies and gentlemen, it's star one. And our next question comes from Brian Hadley. Go ahead, Brian.
Hi, you talked about switching over from equities more into the bond market for stability next year. How rapidly in the portfolios does that change happen? Is it something that's done quite instantly, or is it a slow progression?
Yeah, it's something that's done more in stages. It's not something that we do in one fell swoop or overnight. So as the market, gets back to new highs, we might start to scale back on our equity exposure incrementally. And then if we saw the market continue to struggle to get back to new highs, we would look to do, more of that, to decrease equities more and add to the bond side of things more. So it doesn't happen in one step. It happens in stages.
And our next question comes from Michelle Kavin. Go ahead, Michelle. Michelle, are you on mute?
Yes, I was. Sorry about that. I was going to ask if rates might start rising, is there any fear with getting into fixed income?
So the Fed, when they raise rates, they're really only controlling the very, very short-term or overnight rates. When we look at the sensitivity that bonds have to rises in interest rates, usually we're talking about more longer-dated bonds like the 10-year Treasury. And so that was the chart that we showed. We don't think that the 10-year Treasury has that much more upside. So, in that case, if you think the Fed only has maybe one or two more hikes left, in that time frame is really when you want to start allocating back into fixed income and adding to that side of the portfolios.
Again, ladies and gentlemen, it's star one. You may also type in the Q&A box.
Is that it?
Yeah, there appear to be no questions at this time.
Okay. Well, thank you, everybody, for dialing in today. If there's any other questions that come up, you can always email or call into the office. And that's it. Operator, thank you.
Thank you. This does conclude today's conference. We thank you for your participation. You may disconnect your lines at this time and have a wonderful day.